this applies to not only you, but the entire market in terms of how to make money. Now, during Warren's annual stockholder meeting, he came out against the app by saying that Robinhood was catering towards the gambling instinct of investors and contributing towards the speculative casino-like trading activity in the stock market. He goes further to say that American corporations have turned out to be a wonderful place for people to put their money and save, but they also make terrific gambling chips. If you cater those gambling chips for when people have money in their pockets for the first time and you tell them to make 30 or 40 or 50 trades a day and you're not charging them any commission, but you're selling their order flow or whatever, I hope we don't have more of it. In other words, his concern is that if Robinhood has a financial interest in getting you to trade as often as possible because that's how they make their money, it unknowingly promotes the type of behavior that could be detrimental to you as an investor at your expense. And words get even harsher from the billionaire vice chairman Charlie Munger, who said that it's just god-awful that something like that brought investments from civilized men and decent citizens. It's deeply wrong. We don't want to make our money selling things that are bad for people. And that is where things start taking a slightly darker turn from what originally turned out to be a commission-free brokerage aiming to democratize investing to now what the most successful investors believe is just a gambling app making money at your expense. For example, a few months ago, the New York Times ran an article describing a 32-year-old investor who said he was lured into the app through features that included falling confetti and emoji-filled phone notifications. But after repeatedly losing money, he took out $60,000 worth of home equity so he could buy up riskier stocks and options, hoping to make his money back. After then having some initial success, turning that account into more than $1 million, he proceeded to lose almost all of it, and now he has about $7,000 left. Now, according to analysis of industry data and legal filings, as well as interviews with current and former Robinhood employees, they say that the app was built on what appears to be a Silicon Valley playbook of behavioral nudges and push notifications to draw investors towards risky trading, which happens to make Robinhood a lot of money in the process, and well, it's working. In the first 3 months of 2020, Robinhood customers traded 9 times as many shares as E-Trade customers and 40 times as many shares as Charles Schwab customers. They also bought and sold 88 times as many risky options contracts as Schwab's customers relative to the average account size. They say that's led customers to making decisions which are not in their own best interest, but instead in the best interest of Robinhood, which benefits from excess trading. Others are also concerned that Robinhood is not doing enough to protect their own customers against the risks of investing, as evidenced by a tragic situation where 20-year-old Alex Kearns took his own life thinking that he had lost $730,000 trading an investment that he should not have been qualified to make. And for Warren Buffett, knowing that 80% of active traders lose money and only 0.03% are able to consistently earn large amounts, he feels like a company which encourages excess trading is doing so at the benefit to themselves and at the detriment to you. Now, Robinhood very much denies this, and they say the new generation of investors aren't a casino group. They're tearing down old barriers to investing and taking control of their financial future. The CEO of Robinhood also said that even with some of their customers losing money, young Americans risk greater losses by not investing in stocks at all, and that they made investing less intimidating to new investors. But Warren Buffett disagrees, and instead his advice was this. He started off by noting something really interesting. None of the biggest stocks in the world in 1989 would still be on that list today, and that is something that investors should pay very close attention to. Like, the top companies of 1989 included the Industrial Bank of Japan, worth $104 billion, Sumitomo Bank, Exxon, General Electric, and IBM. He goes on to say that we were just as sure of ourselves, and Wall Street was, in 1989 as we are today, but the world can change in very, very dramatic ways. His biggest lesson here is that even though you might be incredibly sure of yourself now, the future is very unpredictable, and it's unlikely the biggest winners today are going to be the biggest winners 20 years from now. That's why he stressed the importance of having a broad, well-diversified portfolio of passive index funds. He also cautioned investors about trying to find winners in growing industries, pointing out that a large number of companies who made automobiles in the early 1900s ended up closing down well before the industry had matured. All of this to say, at the core, buying and selling speculative stocks through a company who benefits from you trading as much as possible is likely to wind up losing you more money than holding on to a passive index fund long term, and that's it. But as far as my own thoughts on this and Robinhood's response to what's going on, here you go. Overall, I feel like Robinhood has done a lot of good for the entire investing community. They've engaged a brand new audience who ordinarily would have had no idea that investing was accessible, and most importantly, they've made investing fun. Plus, you can almost get near instant access to leveraged money through options options trading, which magnifies your return in a very short period of time. But the question then becomes, has Robinhood taken this slightly too far and made this slightly too fun? Well, the behavioral finance professors Brad Barber and Terrence Odian, who have studied investor performance over these last few decades, believes that yes, they have taken it too far and it might be time to pull back. In a recent study, they saw Robinhood as a platform that included features to make investing feel more like a game, such as getting a free stock through an image that looks like a scratch-off lottery ticket with confetti coming down once you're finished. They say that's more likely to attract new, unsophisticated investors who have no prior experience investing. The top 20 movers also encourages investors to buy a limited selection of stocks based on past performance, while the simplification of information leads investors to rely more on their intuition than on critical thinking. Not to mention, even more surprising, it was found that the average Robinhood investor had just 3 stocks, which suggests a lack of diversification and overconfidence, which would lead to an overall lower return. They even went so far as to say that sophisticated investors would be able to exploit patterns within Robinhood's platform to short stocks which experience a run-up based on Robinhood's recommendations. However, in Robinhood's defense, the finance professor Chester Splatt argues that active stock trading may not be as beneficial over the long term as simply holding onto a low-cost index fund, even if the trading is commission-free, but it could still be better than leaving your money in a savings account. In terms of my own opinion, though, I see both sides. Their target demographic, much like mine, is probably between the ages of 18 and 35. They want to learn as much as they can about personal finance, and it's up to you to make it as accessible as possible to a demographic that otherwise might not ordinarily be interested in investing. I've done this through relating titles and thumbnails back to real-world scenarios where on their own they're super boring, but then add some spice to them, and all of a sudden they're exciting. For example, I could have made a video about how to set up a Roth IRA for new investors step-by-step in 2021, but guaranteed, the people who needed to see that video the most would skip past it because that's boring. However, if I titled that video "How to Be a Tax-Free Millionaire with $12 a Day," all of a sudden I could reach almost 1 million people and help them see the benefits of starting up a Roth IRA as soon as possible. I really think investing is a topic which needs to be positioned in such a way that attracts people who ordinarily wouldn't think about starting a 401k, or building up their credit score, or investing in a broad index fund, which otherwise is dull. And from that perspective, I feel like Robinhood followed that same path because that's what they needed to do. They had to make investing fun if they wanted to grow their platform, and they had to push the limits and rush out some features when they're competing with multi-billion-dollar corporations. But I do admit, and I've said it openly, that lately it's started to feel more like a casino and gambling than a stock trading platform, and Robinhood seems to be at the center of it. Now, I get that some people just want to be left alone, and they think that if they lose money, that's their own fault. But the SEC has determined that it's their responsibility to step in to protect people against themselves once the company has a financial interest in you doing something that increases your likelihood of losing money. Over time, I have a feeling they're going to be more strict about their disclosures, they'll limit activity until you reach a certain threshold, or they're going to remove features which might be too gamey for an investment platform. Other brokerages are even making a positive change in that direction ahead of time. For example, the stock trading app Public, who recently announced that they've stopped the payment of order flow, so there's absolutely no conflict of interest. And they've created disclaimers around investing in certain stocks which have a higher chance of volatility to protect you as the customer. It's really tough because on the one hand, I feel like people should have the freedom to do what they want to do without any limitations. But if a company profits from you doing something that could be detrimental to you long term, that needs to be disclosed so that you know the risks associated with what you're doing. Let me know what you think of this down below in the comments, because I certainly see both sides of the equation, but overall I tend to agree a little bit more with Warren Buffett that what we're seeing right now is more akin to a casino than it is investing. And eventually I could certainly see more regulation put in place, not because they don't want people to invest, but instead because more transparency never hurt anybody. So with that said, you guys, thank you so much for watching. I really appreciate it. As always, make sure to
Brian is with us in Kansas City. Hey, Brian, welcome to the Ramsey Show.
Hi, Dave. Thank you. So my question today is, basically me and my wife decided that this was going to be the best year to build a house, and we're kind of finding out that's not really true. So we went under contract 2 months ago, gave our contractor the earnest money and the deposit. Haven't really heard a lot back from our contractor. They haven't broken ground yet. And then last week, we got an email that said, due to material prices increasing, they have to raise the price of us, of the materials, and they have to raise
from the deal?
Yes, sir.
Okay. Not the morality of them raising prices.
No, not the morality of them. The morality of me walking away from a contract that I agreed to.
Yeah.
That was dumb.
So how much did they raise the prices?
3.5%. So it's about $10,000. And the other thing in the email they said is that they can no longer lock down prices with their vendors. So whenever they order, say, lumber for frame of the house, whatever the price of lumber is that day is what we'll have to pay. So it looks like the price of the house is going to increase also.
More than what they've already told you?
Yes, sir.
Okay. And what's the price range of the home? What is the price overall?
The price was $315, and it's about $325 now.
And what's your household income?
About $90,000.
Well, to start with, let's just say that what they're telling you is the truth. Lumber is going up rapidly. That's not a lie. And they have the contractual ability to raise the price. And my guess is the market's hot enough that if you don't buy the house, they can sell it to somebody else.
I would agree.
Yeah. So I don't think they're going to be harmed in this situation. But basically, you'd have to get a turn down letter turning you down for the loan from your mortgage broker.
Yeah, he said that's no problem.
I don't have an issue with the morality. I mean, the deal has changed. Nobody in this deal anticipated that the deal was going to change. And based on the change, you don't want to be in the deal.